Okay, let's look at monetary policy. So now let's look at when the Reserve Bank of Australia runs expansionary monetary policy and when it runs contractionary monetary policy. Right? So we're going to look at monetary policy, and we're going to look at when expansionary policy is necessary and when contractionary monetary policy is necessary. So you run expansionary monetary policy when the economy tends to be in a recessionary gap, right? That inflation is quite low, below the 2 to 3% target set by the government for the RBA to follow. So inflation is less than 2%. And you run Reserve Bank of Australia runs contractionary monetary policy when the economy tends to be in an inflationary gap. Inflation is higher than the 2 to 3% band that they're supposed to keep an eye on, right? It's higher than 3%. So let's look at these two situations, right? So we can start off by looking at the expansionary monetary policy. If you remember what we did in the lecture, we look at three different graphs. So let's start with the first situation. You are in a recessionary gap. Okay. So if you're in a recessionary gap, the economy is not doing well, output is less than Y star, and recall that the government has asked that the Reserve Bank of Australia maintains inflation between 2 to 3% over the business cycle. So let's assume at the moment that this is not where inflation is. The economy is not doing well, people are not spending money, and inflation is less than 2%. Let's say inflation happens to be 1%. So the Reserve Bank of Australia is tasked with maintaining inflation between 2 to 3%. If it's less than that, as it is now in my example, inflation is 1%, then it must take steps to increase the price level, because remember, an increase in the price level is inflation, right? And one way to do that is to boost the economy so people spend more money, so prices will eventually go up. So it can run expansionary monetary policy. Let me put that off to one side. Okay, so we can start with our initial situation, looking at the economy. Economy is in a recessionary gap. So economy would be Y0, price level P0, right? So we're looking at a situation where the economy is not doing as well as it could be, and the price level happens to be P0, which is not the price level that the Reserve Bank wants it to be because the rate of inflation is too low. Okay, so given this situation, I'll put this to one side. Given the situation over here, the RBA must act to increase inflation. Okay, the RBA must act. I can't seem to make that bigger. Okay, I'll put that back. Okay, so it must act to increase inflation. So it will run expansionary monetary policy. Right? So what is expansionary monetary policy from an applied perspective? What does expansionary monetary policy look like? Well, it would mean lowering the cash rate. The Reserve Bank of Australia would lower the cash rate. Okay. And that would involve an open market operation. An open market operation, right? Whereby that they will want to increase the money supply. So what they will do is an open market operation purchase of government securities will occur. An open market operation purchase of government securities will occur. So what does this look like? Well, okay, let's explain that situation. Put that to one side. What does an open market operation purchase of government securities look like? Well, essentially what is going to happen is that the Reserve Bank of Australia will buy back government securities from the commercial banks. Let's say ANZ, but it's not just ANZ, it's Westpac, it's National Bank, it's all the commercial banks from ANZ. Okay, so what will happen is when they buy back the government securities, remember government security is just a piece of paper with a value on it, right? Reserve Bank of Australia says this is a piece of paper worth $100, right? When they buy back that government security, they will have to give the ANZ some money, right? So once they do that, they would have to give ANZ and National Bank and Westpac money, right? Which they don't actually give them cash. What they will do is they will increase ANZ's reserves in their bank account at the Reserve Bank of Australia. So they'll put the money into ANZ's bank account, right? They won't give them actual cash. They'll put the money in their bank account. This will increase the reserves that ANZ holds. Okay. This has the net effect of increasing the supply of reserves in the economy, and with no change in the demand of reserves, reducing the cash rate. What does that look like? Let's draw it up now. We draw another diagram. The cash rate for the cash rate. Okay, so here you have your amount of reserves. Here you have the cash rate. Here you have your reserves for your demand for the reserves. Here you had your initial reserves of supply, we call that RS0, and the initial cash rate happened to be C0, and total reserves were R0, right? So what we then saw was with the open market operation, with this open market operation over here, there was the open market purchase of government securities, which, if I can bring that one down, let me put this to one side then. I bring this one down, make this bigger. Ended up increasing the reserves for the ANZ and increasing the supply of reserves and lowering the cash rate. What does that look like? Let me put this back. It's starting to look a bit dodgy. Is you're getting yourself an increase in the supply of reserves, RS1. You just move down, get to your new equilibrium, and you find that the cash rate has fallen. And the amount of reserves available to ANZ, Westpac, National Bank, all the commercial banks have gone up, right? So essentially what this graph is saying is ANZ has more money available. This money is put in their bank account at the RBA, and the RBA is paying them an interest rate of C1. C1 is a very low interest rate, right? So if you are ANZ, you're not going to be happy to keep your R1 amount of reserves at the bank account at the RBA. So what they're going to do is they're going to take some of this money out and they're going to lend it to you and me. They're going to lend it to the consumers. It's going to go into the money market, right? So you're going to see an increase in the money supply. So let's look at that now. So now what you're going to see is another graph, right? We're going to draw our third graph. Okay, so let's say this is your money market. So this is the amount of real money balances. This is your nominal interest rate. This is the customer's demand for money. Let's say initially this was the money supply. The nominal interest rate was I0, and the amount of, or the quantity of money demanded was, let's say, X0. Right, so this is the original situation. And then what do we know? What happened after that? Well, we know that now Reserve Bank of Australia has given more money to ANZ. ANZ will use some of that extra money to lend to consumers. So there will be an increase in the money supply. Again, not just ANZ, all the banks. So MS1, with more money available to lend and no change in the demand for money, the nominal interest rates will fall, and the quantity of the money demanded will increase. There will be a fall in nominal interest rates, and there will be an increase in the amount of lending, which means there will be an increase in business activity. People are borrowing more money. Business activity. People are borrowing more money. Let's say businesses are borrowing more money. If businesses are borrowing money, this is going to have an impact on aggregate demand. Let's move this to one side. Let's bring back our original diagram. Come on. There we go. Right. Remember, if I just make that smaller for a second, remember that we know we have aggregate demand equal output equal C plus I plus G plus NX. What the Reserve Bank has done is the Reserve Bank has reduced the cash rate, which has ended up reducing interest rates. Interest rates have an effect on business borrowings, on investment. The cheaper it is to borrow money, when interest rates fall, you will see an increase in investment. That would be an increase in aggregate demand and an increase in output. So there will be a shift out in your aggregate demand curve. And we'll end up with the new aggregate demand curve. Let me draw that a little bit better. 1, you will see an increase in the size of the economy and an increase in the price level. Okay. So the economy will improve and the price level will go up. And remember, an increase in price is inflation. And the Reserve Bank of Australia will continue this process until inflation reaches between 2 to 3% of the economy. Right? And that is your expansionary monetary policy. Then we can do exactly the opposite thing for contractionary monetary policy, right? So now there's an inflationary gap, and inflation is higher than what the Reserve Bank is comfortable with, right? Let's say inflation is 4%. The economy is doing quite well. So the Reserve Bank of Australia must act to reduce inflation. Okay, so we start off at the situation of an inflationary gap. So you got your Y star, your aggregate demand, your aggregate supply. The economy is at Y0. Y0 means the economy is doing better than normal. And the price level is P0. And P0 is too high a price level for the comfort of the Reserve Bank of Australia. So the Reserve Bank of Australia wants to reduce inflation. And one way to reduce inflation is to reduce aggregate demand, to make people spend less money. So it's going to run contractionary monetary policy to slow down the economy. So it's going to do exactly the opposite of my previous example, right? Now you're going to see contractionary monetary policy in action. And that is going to involve an open market operation, right? There's going to be a need to increase the cash rate, which is going to happen by having an open market operation sale of government securities. So what is going to happen with this situation is the Reserve Bank of Australia will go to ANZ and National Bank and Westpac and all the commercial banks, and they will say, you need to buy our government securities, right? So they will sell government securities to ANZ, for in my example, right? But again, any of the commercial banks, and ANZ will give money to the RBA, right? Essentially what happens is ANZ has a bank account with the RBA will just take the money out of there. This will reduce the amount of reserves that the ANZ has. They have less money available. What does that look like? Right. Well, here again, we just do the opposite of what we did in the previous example. Here you have your reserves. Here you have your cash rate. You have your initial situation, the demand for reserves, your initial supply of reserves, RS0, the initial cash rate, C0, and the equilibrium amount of reserves available. And then what happened? The Reserve Bank of Australia sold government securities to ANZ. ANZ gave them money, so they have less reserves available. Fall in reserves. That is going to be denoted by a shift in. You move up to your new equilibrium. The cash rate rises to C1, and ANZ has less reserves available. Okay. So when they have less money available, they have less money to lend to you, right? Because they have less money available. They cannot just lend money to just about anyone. Plus, they're getting a higher interest rate, so they might want to just keep it at the Reserve Bank of Australia anyway, right? So this will have an effect of reducing the money supply. So let's have a look at that situation. So we can draw up that one. Here you have your real money. Here you have your nominal interest rate. Here is the demand for money. Here is the initial money supply, MS0. The initial nominal interest rate and the quantity of money demanded for business activities, for example, X0, right? And then what are we told? Well, we are told there is now a fall in the supply of money. Okay, let's depict that in the graph. So you just move along until you reach your new equilibrium. The nominal interest rate goes up. That means it's more expensive to borrow money. That means businesses will borrow less money. And the quantity of money demanded will fall. It's going to be less business activity. Less business activity. Okay. Which means there's going to be a fall in investments, which is going to affect aggregate demand. Remember, aggregate demand equals Y equals C plus I plus G plus NX. If there is going to be a fall in investment, there will be a fall in aggregate demand and a fall in output. That is going to be depicted back in our original graph as a fall in aggregate demand. So it would look something like very badly drawn. Let me try that again. Again, it's not as easy as it looks. There we go. AD1. There will be a fall in economic activity. And remember, it's all about lowering inflation, a fall in the price level. We reach back to long run equilibrium. And well, I can't move that, and there will be a fall in output and a fall in inflation until the Reserve Bank of Australia takes the economy back to a situation where inflation is between 2 to 3%.